Hello everyone, welcome to the session. Two companies operate in the same sector. They manufacture similar products. They emit roughly the same amount of greenhouse gases. Yet, one company continues to attract global investors, secures long-term contracts, and positions itself as future-ready, while the other faces penalties, has strained stakeholder relationships, and is increasingly facing scrutiny. The difference is not the volume of emissions alone. The difference is how those emissions are measured, understood, and managed. That difference is greenhouse gas accounting. In today's economy, carbon is no longer just an environmental issue. It's a measurable business risk, and when managed well, a strategic business opportunity. Let's start with the most practical question: why should a business invest time and resources in GHG accounting? At its core, GHG accounting helps organizations understand where energy is being consumed, where fuel is being wasted, and where inefficiencies exist. When emissions are measured systematically, cost leaks become visible. Many organizations discover that their highest emission sources are also their highest operating cost centers. Inefficient boilers, fuel-intensive logistics, outdated equipments, or poorly managed energy use. In India, large industrial players like Tata Steel use detailed emissions and energy data to optimize fuel mix and improve plant-level efficiency. Globally, companies such as Unilever track emissions across the operations and supply chain to reduce material wastage, improve logistics planning, and make products more resource efficient. These actions are driven by emissions data, not assumptions. The result is not just lower emissions intensity, but also measurable reductions in operating costs. GHG accounting, when done properly, turns sustainability from a reporting function into a cost intelligence and operational insight. Compliance and market access. What was once voluntary is now increasingly expected, and in many markets is unavoidable. Governments and trade blocs are introducing carbon disclosure requirements that affect how companies operate, sell, and compete. Without accurate emissions data, organizations struggle to meet these expectations consistently. Poor quality data today often leads to non-compliance tomorrow. This is particularly relevant for an export-oriented business where emissions reporting is becoming a condition for market access. At the global level, mechanisms such as carbon border adjustment mechanism require manufacturers to disclose product-level emissions. Companies without a reliable GHG inventory risk facing additional costs or losing access to key markets altogether. The message is clear. No credible emissions data means limited credibility in the marketplace. Investor and financial expectations. Investor expectations have also changed fundamentally. Today, investors do not evaluate companies based only on short-term profitability. They increasingly assess whether profits are sustainable in a carbon-constrained future. Greenhouse gas data feeds directly into the ESG assessments, risk models, and capital allocation decisions. Organizations with weak or inconsistent emissions data are often perceived as higher risk. In India, banks and financial institutions are increasingly evaluating emissions performance when financing infrastructure, manufacturing, and real estate projects. Companies with poor disclosures often face stricter lending conditions or higher cost of capital. Globally, large institutional investors managing trillions of dollars expect companies to disclose their emissions trajectories and climate-related risks. Where data is missing, uncertainty increases, and the uncertainty is priced as risk. In simple terms, no data means higher perceived risks. Carbon footprint management and strategy. Beyond compliance and investment, GHG accounting forms the foundation of carbon footprint management. It allows organizations to understand emissions across Scope 1, Scope 2, and Scope 3, identify hotspots, and prioritize reduction actions based on impact rather than intuition. Without a clear emissions baseline, targets such as net zero or carbon neutrality remain aspirational statements. With structured accounting, they become measurable strategies. In India, IT companies such as Infosys and Wipro use carbon accounting to manage electricity consumption, increase renewable energy procurement, and track emissions from employee travel and data centers. Globally, Companies like Microsoft use detailed emissions inventories to implement internal carbon pricing and engage suppliers on emissions reduction. The key point is this: you cannot manage carbon without estimates alone. You need accounting discipline. Let's pause for a moment and reflect. Which of the following decisions depend on accurate greenhouse gas data? Is it compliance planning, investment decisions, cost reduction initiatives, or net zero strategy? The answer is simple: all of them. Greenhouse gas accounting is not just about reporting numbers for the sake of disclosure. It's about credibility, strategy, and long-term readiness. When emissions are measured correctly, organizations make decisions financially and operationally and strategically. Thank you for watching and stay tuned for more such updates from ReGeneva.